Hello, my YouTube friends, and welcome from Belgium, Brussels. Well, I'd like to be more excited, but I was a little disappointed, I hate to admit. Anyway, today is part two in that three-part series of how to invest $1 million. We're going to talk about how to invest $1 million if you're 45 years old. So stick around, I hope you find it interesting. Good morning. My name is Adam Kahn, and this is Investing with Adam K. I also still think of myself as a rational investor. I hope you're all doing well, enjoying your day. We're here on vacation. One of the YouTubers actually said making memories, and I kind of like that comment. I'm here with my family taking a nice vacation. My son's 13. I try to spend as much time as I can in the summer. And since I can work off a computer, we really make some nice long trips and spend some good family time together. Anyway, I wanted to talk about the second leg of this three-part series on how to invest $1 million. I'm focusing on 45 years old, and most of the investments are how what I would invest in equities. I didn't spread out into bonds or to other things. Even the one when I get to 65 years old, same thing. I've just slowly shifted into more dividend stocks. So the first three stocks that I'd be invested in, similar to the last portfolio at $75,000 per each stock, is Microsoft, Amazon, and Meta. I'm still in those fields of growth. I'm not at the point of retirement quite yet. These are great companies, probably the best there are. And somebody made a comment in the last video about valuation. Now, keep in mind, I tend to ignore it to some degree. I don't totally ignore it. I definitely pay attention. But at the same time, there's certain companies I just want to make sure I own, and I don't want to pay too much attention to the valuation because you miss out on great opportunities when you do that plenty of times. I've watched plenty of these stocks just run and run and running, keep running, and they're consistently overvalued. That makes sense if they're continuing to outperform and continue to grow and continue to post better earnings. And Meta, to be perfectly fair, I think is completely reasonably priced. I think Zuckerberg, a lot of people don't like him very much, but his earnings have been crushing it. And his forward PE is really reasonable for where the stock price is. They just don't like how much he's spending on the metaverse, and I mentioned it in the last video. That's actually one of the things I like about Meta. He hasn't just kicked over and turned into a dividend stock relying on the income coming in from Facebook and Instagram. I think he sees that there's a potential that those could slow down over time, and he still wants to grow and be the biggest, baddest stock out there. So he sees this metaverse as the next frontier of area where he could continue to grow. I think while Oculus right now is just a toy, his vision, along with the Vision Pro of Apple, is people going to school on these things, people going to sporting events, buying tickets, different price for different tiers of different, the best seats in the house versus the nosebleeds. And then even advertisements on pizza you could order at the halftime show or whatever it is. But how about being able to be there for the halftime show and have a spot right in the stadium where they'd be recording and filming and doing live events on Oculus? Or going to school and getting the best science teacher. I mean, I used to watch this guy, Mark Rober, on YouTube with my son who loved him. He's incredible at science. Well, maybe that guy could teach 10,000 kids science and somehow AI could actually grade their papers or whatever. I really do think the metaverse is that next level. And then in terms of Amazon, I mean, I think they're a really well run company and really well diversified. When I did an interview on Ari Gutman, I even made a comment that if there was only one stock I had to invest in, it would probably be Amazon because they're so well diversified and they're still growing at a pace that I really am impressed with. So these are three companies, Microsoft as well, once they went to that subscription model, I think it really changed their direction in order to be able to continue to grow going forward. It's a great model to switch to versus just pay and own and maybe your thing gets outdated where it's a little bit lower of a price but you continue to pay every month. If Microsoft just raises the price a couple of dollars percentage wise, that's a significant increase. which is why I see the value in that stuff. And these are three companies that just continue to perform and continue to be and continue to grow. And at 45 years old, you still want growth in your portfolio. You want a little bit more security. You don't want to be in the high flyers. At least you want, if you do, you want a very small percentage. But at least for me, by the time I'm 45 years old, I don't want to have the risk of like having a big loss in my account because I want to make sure I'm in the right position by retirement. So the next two equities I'm going to talk about at a 45-year-old that I think are a good fit are Caterpillar and Pepsi. Again, also a $75,000 investment. I try not to spread out into too many equities. If I wanted to own 30 equities, 40 equities, I might as well just buy the spiders and the QQQs and not think about it a whole lot. But my hope is that I'm picking stocks that'll outperform the market a bit. And if they don't, they should keep up with it. Both Pepsi and Caterpillar, a much smaller one, do pay a dividend of sorts. Um, I like Pepsi more than Coca-Cola because I think they're a little bit more rounded. By the time you add Frito-Lay and Taco Bell and some of the other things mixed into the company, it gives them more ability to expand. It shows that they're not just a drink company. While I love Coca-Cola and I understand they're the most recognized brand across the world, or at least the logo, I do think they limit themselves by being just a drink company. And Pepsi, on the other hand, shows that they're willing to move into snacks and restaurant and things like that to incorporate all sorts of things, which I think gives them a bit of an ability to potentially grow. I know they're number two in the name and Coca Cola has a stronger name. I still like Pepsi better for that reason. Now, Caterpillar is just a company I love. I think that they're the only one in the space where they build those machines and products to dig ditches and roads and buildings and things like that. I have seen some much smaller electric ones at a show that I saw actually on YouTube. I would have loved to go to the show. It looked really cool. But I saw that Honda was building some, they were almost miniaturized ones. And Caterpillar, like if you're going to redo the roads in the US, it's hard to imagine them doing them with any other company than Caterpillar. Or if you're building a new high rise or skyscraper or things like that. And Caterpillar seems to be in a space that I just don't see anybody spending the money to be able to compete in. I think it would be really hard to just decide, okay, we're going to build a bunch of bulldozers and tractors and start competing with them. And then John Deere is on a different level. They're not quite the same. I think they're really geared towards farming and things of that nature, unless I misunderstand something about it. And I think it's more likely like an individual might buy a Deere product. So I think Caterpillar is in a space that's very hard to compete, and they're going to be there a long time. And I don't see them having some huge growth span like they did of recent, where they're going to like double or triple in a small amount of time. But I do think they'll just continue to slowly grow and outperform inflation. So my next two are Bristol Myers, Exxon Mobil. Both great companies, both paying dividends. Bristol Myers I've been picking because I think they're a little undervalued right now, and I want something in healthcare. I think Pfizer and AbbVie are also great companies. AbbVie, my trouble is I think they've had a nice run already, and I don't know that the value is there. Like, don't get me wrong, I probably like AbbVie the best, but I actually personally rotated out of it into Pfizer and Bristol Myers because Bristol Myers and Bristol Myers and Pfizer are out of favor right now. While AbbVie seems to be so popular, I think it's a little bit overpriced. And they're all in the same space. I'd rather buy the ones that I see are discounted, which goes back to that first part where I was talking about Meta and Amazon stuff. I am sensitive to valuations, but I still want to just own great companies no matter what. And sometimes I try to pay attention to it. Sometimes I try to not be too sensitive to it because there's certain companies I just want to own. Anyway, Bristol Myers gets me in that healthcare space, and I think they're discounted. ExxonMobil puts me in the oil and gas, and I think they're priced just fine. I think Chevron's another good one in that space too. I don't think it matters if you wanted to split it in half and do what 37,500 of both, or just own Chevron or Exxon, but I do think you want some oil and gas in your portfolio, even at 45 years old, even at 25 years old, and possibly even at 65 years old. They're just a big cash cow. They continue to make money, they continue to grow despite all the transformation from oil, ice engines, what internet combustion engines. I'm having a brain fart to electric vehicles, primarily because there's still going to be tons of things that use oil. Even Vaseline is oil, but you're also going to have big boats and planes and everything else. They're not going electric anytime soon. These companies have a long, long time horizon. On top of the fact that they're more of just energy plays that'll continue to evolve and be in the space in one way or another, is my guess. So at 45 years old, I'd also want some Nextera Energy Partners, also a $75,000 investment. And I also have UPS on my list. And part of the reason I have UPS is back to that valuation. I think right now they're out of favor, and UPS is one of the top in the logistics category. I mean, we're all familiar with UPS, and they deliver worldwide. They're a great company, really well run. I understand they had some employment issues where they made some contracts where people might have been getting paid too much, but I think that's part of their layoffs and why they've let people go is they recognize that as we've slowed down a bit. I think they'll have a total ability to adjust to the economy. They've been around long enough to know what to do throughout different economies. I mean, these corporations, the longer they're around, they're better they get at being able to maneuver through these things. I just don't see it being this huge, big thing that lasts, 10, 20 years where they struggle for a long time. My guess is they struggle for a year, people forget about it. They're paying an unbelievable dividend right now, so I think that's really nice. And I think that's just the benefit of the stock price falling. And then you have Nextera Energy, which is the largest energy producer and they're out of Florida. I think it's a great spot to be in, back to the EVs and the way that the world's going with Bitcoin and crypto and the amount of energy that things are using. You definitely want to have some money in that space. And of all the ones I look at, I think Nextera is the best one to be in. They actually had a huge stock drop not that long ago. They've already rebounded back up into the mid 70s, but even here, I think they're a good price to be getting long. I like Nextera Energy. It's actually one of my favorites. Next three, all $75,000 a piece. Target, Starbucks, and Costco. All three great companies. I'll talk about Costco first because it was the toughest one. I actually have Costco or Pfizer put in there because Pfizer pays a better dividend and I think it's more stable. So depending on how conservative a person is, which brings me to a point I forgot to mention, this is not financial advice. Please don't use my information for deciding what you need to do in your lives for financial decisions. Really, it's part of why I did the 25, 45, 65. It also depends on your job, your income. There's so many factors as to what people should be invested in that you shouldn't be listening to me or any YouTuber because it's not like we've had a consultation, gone over your position where I can give personalized instructions to a person. This is just the way that I would do for me, and I get pretty heavily invested in equities. I used to be a little more spread out in other things. I've slowly over time rotated more into the stock market simply because for me it's what fits best, and that's not necessarily what fits you guys. Anyway, my concern with Costco, the reason I went back and forth on it is I do think that they're overpriced. The problem I have with that is you don't want to miss out on Costco either. They only have like 850 stores across the world. And when I think about Costco and what they do, that's like minuscule, and their ability to grow from there is incredible. I mean, there's no reason they couldn't have 4 or 5 thousand stores. And every Costco I go to is super busy, which might be why they keep it limited, and they might have good analytics as to their expansion plans. I don't want to overthink it, but I don't know why they don't just put up double the stores in a year or two, because my guess is they'd be pretty surprised how busy they continue to be. They run a great store, they have a good product, It's just something I really love. And even that $1.50 hot dog, I'm amazed how busy it gets just for people coming in to get that. It blows my mind away. And then Target is just a company that I like in general to be in the retail space. I know we have Amazon already, so it kind of overlaps a bit. But I think Target has great growth, like their growth projections look really good, and they've now added that what do they call it, the red circle or something, where they'll do same day deliveries in under 2 hours to start trying to compete with Amazon. Where they're missing things are probably like the Amazon Prime type of stuff, where you can get the movies and the music and some of the other stuff that comes with it that makes that free service all the more attractive. Either way, Target's got a great variety of products. Every time they get in the news about something that seems bad, I think it ends up being good in the end. So it's like lowering their prices is just the competitive nature of the business they're in. It really isn't that big a deal. And last time when the bad news came out about, oh, their woke politics and they're closing stores and everything else, you kind of have to think about bad news creates opportunity. I didn't include Boeing in the list for a reason, but I think as a trade, Boeing is a great opportunity. The news was so bad, it's driven the price down pretty low. And sometimes I get a little bit, conspiracy theorist where I think people put that bad news out on purpose in order to buy their stocks. Like, I think there's a bit of a game going on sometimes, and sometimes the people who want to be buying the stocks are the ones who are putting out the bad information to drive the price lower in order to get that good deal for themselves. Target doesn't quite fit in that category because that already happened when the stock fell below $110 a share. But currently, after their last earnings that were just fine, the stock got cracked because they made a comment about how many products they're going to start lowering prices on. I don't see that as that big a deal. And then Starbucks. Starbucks has been a tough one for me just because their last earnings had me really annoyed. The reality, though, is Starbucks has been on my list of one of those stocks that I do own, not just I want to own, since over $100 a share. It keeps going lower, which makes me second guess it. And the last earnings were so terrible. And not just that the earnings were so bad, the way that the CEO handled it was awful on top of it, giving no confidence that they have any idea for the future and what direction to go. But it's kind of funny. I still drive by, they're beyond busy. And now that we've come out here, geez, every Starbucks I see, whether it's at the airports or even in Brussels, where there are plenty of coffee shops that are so much better, they're busy. They're really busy, which goes through what I say about these great companies with great brands. They'll figure it out, even if the CEO doesn't have any vision and doesn't do anything. My guess is they'll continue to expand into new places and continue to grow. At 45 years old, hopefully you still have another 30 years of investing to give it the time it needs for Starbucks just to continue to grow. My guess is, despite the bad earnings and the bad discussion with the CEO, it probably created a good opportunity to pick up the stock cheap. Just hard for me since I already had it from higher. It's one of my larger positions because, I think they fit in that realm of they'll have times where they fall in half, but over the next 20 or 30 years, they'll do quite well. They have a good product, they pay a decent dividend. As long as they keep their eyes on the prize and stick with what they do, I think they'll be just fine. So Starbucks is on that list as well. And Starbucks is really on my main list also. I just frustrated with them personally. And then the last two I have on the list at a little bit of a less smaller investment is 3M and Archer Daniels Midland. I put $50,000 each in those, mainly because that's what made the math to make sense so that we're $1 million total investment portfolio. I think both 3M and Archer Daniel Midland are great companies that have had some bad news and are pretty discounted right now. I think it creates a really good opportunity to own two very good companies at a discounted price. 3M had a lawsuit that's going to take a little bit of time for that to get paid off and be off their books and allow them to continue to grow. But they have like over 2,000 products in their SKUs. You're probably familiar with things like Post-its and things like that. But they're also in medical and all sorts of things. And 3M is just a great company with a great brand and tons of products that I think give them the ability to continue to grow over the next 10, 20, or even 30 years. And I just don't see them struggling all that much now that they've gotten past this lawsuit. Archer Daniels Midland, similar, except they didn't have a lawsuit. Primarily, their CFO was doing some funny business on the books. The interesting thing is that was like a one-time blip, but meanwhile, it drove the price down like it was 30% cheaper than it was at the highs. Archer Daniels Midland rarely has opportunities where it falls like that, and I think it's just one of those slow and steady, boring companies. They're also paying a 3% dividend right now, which isn't too bad. Which leads me to one comment about what I've noticed about the 10-year Treasury. It makes me think I'm probably right about what's going on with the Fed right now. The 10-year keeps drifting lower in yield, higher in price, which makes me think that the Fed speak is probably going to get a little bit more favorable, that they're really in the position that they're going to end up cutting rates sooner than later. I doubt they will at this next meeting. Odds are they're probably going to leave them the same. I don't think they'll do a surprise cut. They've been pretty transparent about their direction and everything else. And the economy, it's not like it's struggling and they have to rush to do anything. But I do think the verbiage and the rhetoric is going to get more friendly towards a rate cut. And I think that's why you see the 10-year bonds, in my mind, improving, which I don't know, whatever you guys hope for is different. But I think that helps dividend stocks, which is why it came to my mind. Something like Archer Daniels Midland, even though it's only paying 3% and you can get 5 in a treasury or CD, my guess is as we start cutting, that'll change and those rates will come down. I also think you might see the yield uninvert and the 10-year not fall quite as far as the shorter duration uh, products. I just think that's how we start to naturally come out of this. And I don't see any big collapse coming. I think what'll be interesting is you'll see the yield uninvert. You'll see the people that are gloom and doom go, well, now it's time that the economy is going to collapse because that's what's happened every time in the past. But I do think this time is a little bit different. I have concerns about how much money the government spent legitimately. Like, I think the debt puts a lot of burden on future generations. But I don't know. It just doesn't seem like it's going to be a major issue because it's in comparison to every other country, and they've done the same thing. So they've all spent too much, and I still think the U.S. dollar is where you want to have some money. I think that slowly you've seen China and some of the others pull out of it. From what I saw, they went from 80% invested in the U.S. equity treasuries, and now they're at 50%, which is a major move, but maybe they even get less so and move more into gold and their own equity or their own currencies or whatever. But it doesn't seem like it's going to impact the economy in the way that we have some great depression or recession, the way the gloom and doomers talk about it. The sad thing to me is the people in the comments who seem to want it. Guys, get it in your head. You do not want a recession like that. I understand you want prices to go back to where they were, but what comes with that is unemployment and chaos and all sorts of things. When you envision everything in your life being the same, but the price is just cheaper, that is not what happens in those big recessions. House prices don't collapse and everything else go back and revert to prices of 2018 without a bunch of havoc, without a bunch of job loss. So for you to think you're just going to be in this great position with continual raises and earning the same money and not being out of a job and oh wow, prices are just cheaper and it's so much more affordable is just an unrealistic view. You would way rather be dealing with some inflation than unemployed having zero income coming in prices being less expensive. What good are the less expensive prices going to do you if you have $0 coming in income? So stop rooting for this huge recession that probably isn't coming anyway. Anyway, that's just my little rant at the end. Again, before I finish, before I go for the day, I hope you're all doing well. I hope you enjoyed the video. Do me a favor if you haven't already, hit that subscribe button, smash that like button, make some comments, tell me what you think of the portfolio, and then stick around. I'll do the one at 65 years old in the next few days. I'm a little jet lagged. I'm a little thrown off. It's like 10 o'clock here, which is 1 in the morning in Las Vegas where I live. Family's still asleep. Well, at least my wife. My son was up because they haven't adjusted so much, but we'll see how it goes in the next few days when I do the next video. Thanks so much.